Last year's stock crash was all about surging interest rates as the Fed crashed the market, raising rates at the fastest pace in 40 years. That crash may not be over for 7 stocks with a $69 billion debt bomb about to explode. Hey Bowtie Nation, Joseph Hogue here with one of the most important factors you need to be looking for in all of your stocks, not just the 7 stocks I want to highlight in this video, a $69 billion debt bomb that could be exploding over the next year. I'm going to explain how it is and how to find it in any stock. We'll get to those 7 stocks next, but first, I'm relaunching our custom portfolio tracker with a 33% discount only with the link below in the description. This is so much more than just a stock portfolio tracker where you put in your stocks, how much you paid. It's also going to tell you the sector, the industry, and the return on each stock. It'll even show you how much you have in your portfolio from each stock. Here you can put in 2 stocks and compare them side by side, as well as against sector averages and 10 critical measures for stock analysis. The spreadsheet downloads all this data directly from the internet, so you get up-to-date information. Here in the Investing Goals tab, you can put in your age, years until you want to retire, and how much you invest each month. The spreadsheet is going to use your current portfolio, past returns, and how you invest to estimate exactly how much you'll have when retirement comes around. It'll also help you find out how much you need to live well. This is a complete stock portfolio and financial goals spreadsheet, and again, I'm relaunching it with a 33% discount. You'll get lifetime access to any updates, videos on how to use it, and how to reach your goals. I'm going to leave that link in the description below to that special relaunch discount, so check that out. But back to our main topic, and to understand how this billion-dollar debt bomb started ticking, we only need to remember what happened to interest rates during the pandemic. Now, this chart shows the real rate on the 10-year treasury, so that's the interest rate after inflation, and you can see it was negative for more than a year. If you borrowed money after accounting for inflation, the government was paying you to borrow. It was an era of free money, not only for stock prices, but also for companies looking to borrow and grow. And one of the ways that companies found to do this was through a zero-coupon convertible bond. Now, these were even better than regular bonds because the company paid no interest, so even startups and risky companies could borrow billions of dollars, pay no interest, and if the stock price just kept going up, that debt would then convert into common shares, into regular stock, and the company would really never have to pay it back. That's how convertible bonds work. A company borrows and issues that debt, those bonds, they get a lower interest rate for that convertibility, even a zero interest rate in some cases, because the bondholders get an upside if the stock price goes up and the debt converts into an equity position. So maybe they're not getting interest for those few years, but if that stock went up, they're going to make big money when the bond converts into regular stock. And this part of the market surged during the pandemic with $60 billion in convertible debt issued in 2021 alone, more than 6 times its typical year's amount. The problem is, and this is where this debt bomb starts to tick, those bonds usually mature in 3 to 5 years. Investors aren't going to wait forever, earning 0% on those bonds, waiting for the stock price to go up. If the price hasn't gone up over to that level where the bonds convert into regular stock over a few years, that company needs to then refinance that debt, pay it back, usually refinancing it at current interest rates. And that is the tick-tock of this debt bomb. This chart by Bloomberg shows the wave of expirations coming on those convertible bonds over the next few years, more than 15 and 20 billion due in the next couple of years, a massive 35 billion in 2026. And since companies typically try to refinance their debt a year before the maturity comes due, we're going to start seeing this play out over the next year, and it could peak. One of our stocks here, and an example in Peloton, you can see what this has done to the shares, issuing more than $1 billion in convertible debt shortly after hitting its stock peak in 2020. They issued those 5-year notes maturing in 2026, convertible debt that at a $239 conversion price, that debt was never even close to converting on the stock price. That was 5-year notes maturing in 2026. It was convertible to 4.2 shares of Peloton per $1,000 principal. So you start to see how many more shares, and one of the problems we'll talk about when we talk about the outcomes and potential problems for this convertible debt, but converted to 4 times the shares per $1,000 principal. So $239 share price versus $145 share price as of the issue. We can see what it's done to long-term debt on the balance sheet, just exploding that debt higher. Now owes $2.27 billion, with $1 billion needed to be refinanced within 2 years. And that's where this debt bomb is going to explode for the companies that we're going to highlight. They're now at distressed debt pricing, so they're going to have to refinance that at 7.5%, 8%, 12% interest rates from 0 previously for non-investment grade debt. Okay, you've got two types of debt out there rated by the ratings agency. It's either investment grade, which is the highest rated companies, and then non-investment grade rating, the junk debts, junk bonds, sometimes we call them. Those are the bonds of companies that have a little bit shakier finances, very much already indebted. They're going to have to pay higher interest rates. That's what these companies are going to have to do. For Peloton, it would be an additional $90 million annual interest expense for a company already losing $1.2 billion a year. That's just one of the two options these companies could take. Neither one is going to be good for companies or shareholders, but one of them is refinancing that debt, going to add hundreds of millions of dollars onto interest expense for companies that are already unprofitable, making them more unprofitable still. The other option, one that actually most of the companies will have to take since they just can't afford that interest expense, is going to be to issue new shares to pay off some or all of that debt. That is going to hugely dilute the shareholders and causing the stock price to plunge on these even further. What you need to do here to find out how many stocks they're going to have to issue or how many shares they're going to have to issue to pay down even a portion of that debt is you take the amount they owed, and we'll go through all the convertible debt that's going to be due on these companies pretty soon here. You're going to take that divided by the current share price, and you see how many new shares they'd have to issue. For example, for Peloton to pay off that $1 billion in debt, it would have to issue over 200 million in new shares. Company right now only has about 340 million shares issued, so this would be a massive increase to the number of shares and dilute shareholders. Now I want to walk you through these other 6 companies, the debt bomb coming for each of them, and really just a tough situation for investors. A warning on all these stocks. If that debt is refinanced, it's going to add to that interest expense for these companies that are already unprofitable. It is going to make it even harder for them, might bankrupt a few of these companies. If shares are issued to pay off that debt, is going to be a massive dilution for investors and just drive the share price down lower. We'll start with Airbnb, ticker ABNB, priced a $2 billion convertible note due March 2025. It's convertible to three and a half shares per thousand, but at a $288 share price. And you can see this company is nowhere even close to that share price. So this debt is going to have to be refinanced, is either refinanced or a share dilution. We're going to look through here. I'm going to show you how to find this just on Yahoo Finance right here. If we go to the finance tab here, we can see the income statement, the balance sheet, and the cash flow statement. Those 3 financial statements you need to be looking at in these. And if we click over to balance sheet, we can see the debt due, the balance sheet debt on this company to see really how indebted they are. Here we see it has total non-current liabilities. That's going to be the long-term debt that is included in this. Also the current liabilities, which is the debt due over the next year. And you can see it has over $10 billion in total liabilities. A lot of that is due over the next year. It's going to have to refinance to keep going. Now, if we look at the cash flow statement, Airbnb is actually in a little bit better position than some of these other stocks we'll look at. It is positive free cash flow. So really what you want to pay attention to is the operating free cash flow. So the cash flow the company is actually generating from the business minus some of this investing cash flow that it needs to make to keep going. It has been able to pay off some of that debt over the last year. It's paid off $2 billion in debt over the last year, still was able to remain free cash flow positive. So Airbnb does look like it can swallow up this debt, probably issue new shares, or just pay off the debt and refinance it, still be free cash flow positive, and still keep the business going. The same might not be able to be said for Spotify. Issued a $1.3 billion convertible note due in March 2026. Got a little bit more time, but $1.3 billion in debt here at a conversion price of $515 per share. Those bonds were issued and convertible at 1.94 shares per $1,000 issued. That equaled about a $515 share price. And like Airbnb, we see here, it is nowhere even close to that conversion price. Remember how this convertible debt works. The company issues that debt. It borrows the money from bondholders. They pay 0% interest rate for that conversion. If it gets to that conversion price, the bondholders just convert it. They take common stock instead of that bond, and everybody's happy, right? The company doesn't have to pay back that bond, doesn't have to pay back that debt. The bondholders, they get stock, which has gone up a lot, and everybody's happy. It hasn't done that, though, and they're going to have to refinance or issue shares to pay off this debt. Again, if we look at here the financials, we go to the balance sheet, we see how much total liabilities and long-term debt the company does have. It now has $1.7 billion in debt owed in long-term debt, $3.5 billion due this year. It has been increasing its debt over the last few years quite a bit. Seems to have paid off a little bit just over this last year. But we can go to the cash flow statement here to see how see its operational cash flow minus investments. It has become cash flow positive here. in the last year. It is $203 million free cash flow positive this year. But look, just last year, it was only $21 million free cash flow positive. So very much a more tenuous position than what we saw with Airbnb. One of my favorite stocks, DraftKings, ticker DKNG, not out of the woods just yet, priced a $1.1 billion convertible note, not due till 2028. So this company has quite a bit longer than some of these other companies. That's why I think it's not quite the problem that we're going to see with some of these other companies. But $1.1 billion due 2028, converted at 10.54 shares per thousand. That would be about a $94.85 share price. This still has quite a ways to go to see that share price go up and potentially convert that debt into the shares for the company not to have to repay it. But it still has a long way to go. So 2028, company probably try refinancing this or doing something with this debt by 2027. That gives them about 4 years to either raise the stock price up to that $94 for conversion or to refinance this debt or to issue the shares to cover that. We can come here to the financial statements, and while this company is growing very quickly, it is still unprofitable. It is expected that DraftKings will lose $1.45 per share this year. Will still lose 27 cents a share next year, so narrowing that loss on the shares, but it is still unprofitable. We can see here it owes $1.4 billion in long-term debt, $1.2 billion in debt and other expenses coming due this year. It does have a strong balance sheet, though, with current assets of $2 billion. So that's what I like to look at on these. I want to see that they have current assets to at least pay off some of that debt, some of that current liabilities, as well as some of the long-term liabilities. But here's the problem I have with DraftKings. I like the stock. I actually do own the stock. I think it is one of the major players in sports betting online and a growing market. But this cash flow statement is just a nightmare. If you look at the cash flow, look at the operating cash flow. It's never been positive here. Negative $315 million just over the last 12 months. They're still investing into the business, and it is free cash flow negative to the tune of $422 million. They cannot afford to have to refinance that debt at those higher rates, pay 7, 8, 12% interest rates on that debt. They can't afford to dilute shareholders and really lower that stock price. It's just going to be a very bad situation if DraftKings can't get that share price up to $94 a share by the conversion date. Probably the company with the biggest trouble here, Beyond Meat, ticker BYND, priced its $1 billion convertible notes maturing in March 2027. So it does have a couple of years, but $1 billion converted at 4.85 shares per thousand. It'd be about $139 per share. And like the others, nowhere even close to there. And there is no way this stock is getting back up to that $139 per share by March of 2027 or before. And Beyond Meat probably has the shakiest finances of any of these companies. It is expected to lose $3.75 a share in net income losses this year, expected to narrow that a little bit to $3, a loss of $3 per share next year. Still very much deep in the red here. The balance sheet looks bad here, folks. Okay, it's got total assets of $1 billion. Total liabilities, so total debt and other expenses, $1.2 billion. That is a bankrupt company. Okay, when you have your assets do not cover your liabilities or your debt. We can look in here. It's got current liabilities of only $75 million, but almost $1.2 billion in long-term liabilities. That's the debt that we were looking at here that is going to need to be refinanced or issued shares, though at this point the shares are not worth very much to be able to cover that debt. If we look at just this $1 billion convertible debt, how many shares they would have to issue, this is just obscene what they would have to do here. $6.82 per share right now. If they needed to issue shares, they needed to sell shares, new shares, to pay off that debt. We just take that $1 billion, and you should be doing these with all your stocks if they have convertible debt or any of these stocks if you own them. We've got $1 billion in convertible debt divided by $6.82, just a rough estimate here. They would have to issue almost more than 146 million shares. You can see right now shares outstanding about 64 million. So they would have to double the share count for this company. Okay, they would have to issue 146 million shares. They've only got 64 million shares issued right now. That would crater this stock price. And if we go back here to the statement of cash flows, the actual cash coming in and out of the company, it does not look good, folks. Operating cash flow has never been positive. This company has been around for longer than than many of these other companies and is not operating cash flow positive. It is not generating positive cash flows from the company. It is down $151 million loss in free cash flow every year. So $151 million of cash going out the doors trying to keep this company afloat. Next one here, Uber announced its $1 billion convertible notes. They're 2020 due 2025, December 2025. So we'll probably try to refinance this debt, pay it off, or do something with it next year. Convertible at a 12.3 shares per thousand. That makes it about an $80 share price. Of course, it is unlikely that these shares are going to get anywhere close to that $80 per share price here over the next year to convert. We're going to look here at the finances. It doesn't look too bad. Uber is a profitable company, so it is reporting profits per share. We can look at the balance sheet and we see that the total assets do cover the total liabilities. If we look here, current assets $9 billion. Doesn't quite cover the current liabilities and nowhere near covers the long-term debt. So a little bit shakier there. It's got $14.7 billion in long-term debt, $8.8 billion in current debt that's got to pay off within the next year. Cash flow, though, it is cash flow positive. So they are generating about $2 billion in operational cash flow. That's come up quite a bit just over the last year here. Investing cash flow, they are still investing in the future for this company, spending about $1.5 billion a year in this investing cash flow. So they are having to borrow. You see this financing cash flow is positive. They're borrowing money year after year continuously. But they still do have $1.7 billion in free cash flow. And Snap, ticker SNAP, just recently got some good news with a tie-up with Amazon, but it is not going to save the company from this $1 billion convertible debt that it needs to refinance or do something with by May 2027. $1 billion converted at 11 shares per thousand. That's about an $89.25 share price. And like all of these, it is nowhere near that $12 per share right now for Snap. It is not going to get to $90 a share probably by May of 2027. So they are going to have to refinance that debt, figure out what they want to do with it. And with Snap, we're going to see that they are profitable. They are reporting net income per share, positive income per share, but it is very much on the edge here. They have $8 billion in total assets, $5.5 billion in total liabilities. We can see that current assets are $5.2 billion of that. Covers the current liabilities fairly well as the non-current liabilities, but they still have $4.2 billion in long-term debt that they're going to need to figure out what they're going to do with over the next few years. And the cash flow does not look good. Just $2 million in free cash flow over the last year. $200 million in operational cash flow does look good, but they are paying off that debt, and they are still spending a lot of money to grow this company, a lot of money in those investing assets. So this is not an absolute killer, but will definitely make life harder for a lot of these companies and other companies out there over the next few years as they look to either refinance this debt or issue shares to pay it off. There are a lot of zombie companies out there, folks, living on borrowed time, borrowed money. So make sure you know what's in your portfolio. Look for that link in the description below and get your coupon code for the 33% discount to our portfolio tracker spreadsheet. Or click on the video to the right for the 7 monthly dividend stocks that will pay your rent. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.